Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So if I'm looking at risk-free rates, well, I can create, and this is why options are going to be priced a little bit differently among different currencies. I can take the exchange rate, I can buy a put option, and I can get the call. So if I'm looking at trying to trade the AUM options, AUM is going to benefit since the Australian dollar is the base currency. Well, that if the world keeps growing, interest rates are higher in Australia, that's actually going to benefit from that. But according to theory, there is no benefit interest rate differential, so it gets priced into the put options. So the put options end up trading a little bit higher than the call option based on what are called option synthetics. And we measure these, the risks of interest rates and changes by what's called the option Greek rho, RHO. There are, in theory, no arbitrage opportunities. Very little chance to take advantage of pricing anomalies. Again, if calls look more expensive to puts, they're really not. It's going to be based on the interest rate differential. Cost of carry creates these illusions. The higher the price of the stock, or again, the exchange rate, the greater the cost of carry. So what's a market maker? Well, these market makers that are pricing the FX options, they're buying and selling these options, and they're either hedging with the spot market or they're hedging in the currency market. They could be actually hedging in the options market also. They're competing for order flow by displaying buy and sell quotations for a guaranteed number of shares or contracts. Once the order is received, the market maker immediately sells from his own inventory. And again, this takes just a mere few seconds. Why would they do that? Because they want to earn the spread. So again, market makers are in it for the spread. Big institutions, though, they might not be in it for the spread. They might be in it as what are called market takers, just taking the offer, hitting the bid, because they have a view on the currency. And that's, again, why a lot of us are trading the currency market. We're not in it for the spread. We're in it because we believe that the dollar is going to rally. The dollar is going to sell off. The dollar maybe might not move, and you might find some option strategies that would benefit from lack of movement. So it would be up to us to decide, what is our viewpoint. These market makers provide liquidity, so that's great. They provide this second market for the options. They're buyers and sellers of last resort. What is the definition of exchange-traded options? Well, as the name implies, they are derivatives. They are the exchange-traded derivatives. They're standardized. They're quick, systematic pricing, and they're settled through a clearinghouse. Every FX option, first of all, you will never trade against the International Securities Exchange. Not like at other spot options, or I should say options broker-dealers, if you will, that are not regulated by the SEC. If you're trading ISEFX options, you are trading through the International Securities Exchange, but these are cleared through the Options Clearing Corp, and the other side of the trade will be done by another customer, a self-directed investor, institution, market maker. Will never, ever, ever be done by the ISE. So we believe, we've been told, a lot more integrity here relative to the other markets. So day to day, what do these market makers do? Well, they calculate option prices based on the underlying price, and they make favorable options transactions. Option prices must be updated quickly and accurately. Benefits of being a market maker, well, they can capture the spread during normal periods. They need to be very nimble. What's the challenge of being a market maker? Well, they're trying to earn the spread, but their option pricing models are they need to continually improve So they have to spend a lot of money on technology. Their networks have to be good. Most importantly, they have to make sure they're not stuck with being short too many of a certain contract and have sort of that naked risk that, oh no, if the dollar goes to this level, they're in deep, deep trouble. If the dollar goes way above this level, they're in deep, deep trouble. So they're trying to offset their risk. So they're trying to reduce or eliminate the risk of extreme outliers. What's the profitability? What are some profitability factors? Well, market volatility. They like market volatility. Some volatility, but not too much. And I can't give you the exact numbers, but they probably didn't. They liked volatility in 2008 to a certain point, but at a certain point it was too much. Exchange trading volumes. They like to see volumes. They want to make sure that their models are good, especially relative to their competitors. They need to be low cost, like any business. And they want to reduce the number of concurrent trading platforms. Remember, market makers never, ever, ever compete with individual investors. So investors should remember that the goals of market makers are completely different than self-directed investors. Market makers prefer individuals that have the best tools. And again, you want to check out fxoptions.com. There's tons of tools there. So you can learn more about options. We have technical tools so that you can trade more profitably for many decades in the future. Benefits for the investor. Investors can pick and choose the best situations based on your own goals and your own risk tolerances. You don't have to quote all the strike prices. You have the ability to trade when and if ever you want. So if you don't feel comfortable, you don't know which way the market's going, you stay out. You just don't have to trade. You enter a trade, you want to exit, well, you could put a stop loss order in the options. It's easy as that. Volatility. When I talk volatility, I normally talk about implied volatility. So what is the market looking for in the future? Variance as measured by volatility. I call it the error factor from the mean. Standard deviation is sometimes called risk. We could look at 68%, 95%. Confidence levels, we never, ever, ever get to 100% confidence. Risk and reward, however, remain in balance. The more growth the market expects for an asset, the greater the option volatility. So as I mentioned, volatility is stated in annualized terms, one standard deviation, very powerful way to sort of understand what the market's looking at. So if I go back, we're on slide 32. Now, as I said, which is the most volatile currency pair? Brazilian real. This is not my opinion. This is fact. As of January 20th, market perception, U.S. dollar, Brazilian real was the most volatile currency pair. That's the expectation. That's it. Followed by the Australian. So this is not an opinion. These were implied volatilities on January 20th. Now, they might be a little bit different today, but essentially it's nice to know where the currencies, each currency pair, U.S. versus whichever one, where they fit. So you can segment them, if you'd like, into most volatile, less volatile, whatever, least volatile. I'd urge you to do that. You could also look at Vega, and I'll be talking more about Vega in the FX Options Greek class that's going to be coming up on February 18th. Vega is the sensitivity to volatility, and its amount the option will increase or decrease by a 1 unit change in volatility. We can look at historical vol, implied vol. I tend to lean on implied more than historical. Historical tells me how much that exchange rate itself moved in the past. Implied is telling me how much the options market is expecting, what the expectations are for the market in the future. So instead of solving for the options value, we use the market price and solve for the IV, or the implied vol. The assumption is that market participants are more knowledgeable in past data, and many experts believe that the implied volatility is the best predictor for future volatility.
To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.